Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited to be joined by Kevin Dean today. Kevin, welcome to the show.
Excited to be here. Thank you so much, Whitney.
Yes. Well, before we dive into the details of Westwind Townhomes, 95 units in Winchester, Virginia, tell us a little bit about yourself and your background and how you got into the multifamily space.
Sure. Very quick background. Located here in Northern Virginia, just outside of DC. Started my career off actually at Fannie Mae on the pricing desk on the capital markets side of the business, working on multifamily transactions on the debt side, and transitioned full time into my business, Rockbridge Investment Group, back in 2021. We've bought about 23 properties, roughly 3,100 units to date, and we do primarily value add and built for rent. Really in the mid-Atlantic and the Southeast.
Oh, awesome. Well, I'm super excited because I know Westwind Townhomes, 95 units in Winchester, Virginia. Tongue twister there, right?
It is. It's tough.
I know this is the build-to-rent community, so I'm super excited to discuss this today. Let's start off the beginning. When did you close on this property and what was the purchase price?
So we closed on this back in February of this year, 2024, and we paid $24.25 million for the property.
Okay, excellent. And so when did you first set eyes on this property and how did you find it?
Yeah, so this property was a property that we were aware of because I'm actually located about 20 minutes from this asset, as it was under construction, and then it was a fully marketed deal. So as soon as it did hit the market, we were extremely aggressive to just get in front of it and really position ourselves as the best buyer. And we can kind of dive into how we did that. But when it first came out, end of 2023, being actually marketed, we made sure to get in front of the seller multiple times, the broker, basically everybody involved in the transaction, so that it was really our deal to lose.
Okay, so how many groups were you competing against and how did you make that differentiate your group from the pack?
Yeah, so I mean, it was a fully marketed deal, so of course price is going to be your most important thing. We differentiated ourselves a few ways. One, this is a secondary market just beyond like the main kind of Northern Virginia market. And because I'm actually located here in Western Loudoun County, which is just on the outskirts of Northern Virginia as well, I understand the market really well, and I understand all the growth that's going out. Even though it's a smaller secondary market, we were able to kind of share with the seller and the broker. We understand that even though this is a secondary market, we understand the growth going out there, and we're going to execute at a very high level because we want to get in front of this deal, and we're not going to be the type of group who's going to come retrade you over small stuff, because we understand the bigger picture of why this is such a unique asset and such a great market. So with that, we had multiple site visits with our lender, with our insurance guy, with the broker, with the seller. We were actually probably out on site maybe 4 times before we submitted an LOI. We brought an equity partner out there with us. And by the time you're on site 4 times, you meet everybody who's kind of the decision maker. It helps a lot just kind of build rapport with the seller, make sure that they know that you've got everything buttoned up and you really understand how you're going to execute on the deal. And that kind of gave us the inside track, so we kind of knew exactly where we need to be on price and terms to win the deal.
Were you concerned at all about overpaying for this deal in this market?
Yeah, I mean, that's always a concern. Of course, you don't really know what's going on in the background. We were told by multiple people that there were offers that were higher than us. But it was, with groups that maybe didn't have the same track record of us of closing at the price that we originally agreed to. For us, we really look at things on a dollar per square foot basis. And because this is built for rent, we also look at it as, individually parcel townhomes. What are retail townhomes selling for nearby? So there are literally properties right across the street for sale that were selling for $150,000 to $200,000 higher than what we were paying on a per unit basis. And we were also buying it well under $200 a square foot. And we're not taking any of the construction risk. So when we look at it in that regard, and then also look at it just on a year 1 cap rate, we're in the high 6s. We felt really good about it. I think another reason why we were able to get into this deal, if you think back to like end of 2023, and really even today when we're recording this podcast, there haven't been a lot of transactions done. So there's, a lot of groups are kind of afraid to pull the trigger on deals. And because we understand this market so well, we were willing to get a little bit more aggressive maybe than other groups were with, earnest money, hard money, timeline, terms, that sort of thing.
Mhm. And I want to put a pin in it right now, but I don't want to lose sight of the question here as far as the exit strategy, because, it's unique for build to rent that differs a little bit from our just traditional multifamily purchase. But I have some other questions for you on the upfront side of this transaction. So, walk us through how you structured the purchase sale agreement as far as like timelines, due diligence timelines, what kind of earnest money you put down. Was any of it hard from day one, or did it go hard later? Walk us through that actual structure.
Yeah, so the way we structured the PSA was we had a 14-day access agreement from the signing of the LOI. And during that time, we also had to negotiate the PSA. And then the timeline was a 60-day close after the access agreement started, right? So really it was like a 14-day due diligence, access period, and then 46 days thereafter to close. And then we did have a 30-day extension available. One of the, in terms of earnest money, I believe it was $450,000, which went hard after the end of the access period. And we, one of the other nuances of the transaction that I think won us the deal was this deal was actually coming out of lease up. So this property was actually built in 2023. When we first started looking at it, it was in the high 60s on occupancy. So the biggest risk here was really on the debt side. What kind of debt can you get? And if the lease up doesn't happen as quickly as you think it'll happen, can you still get to the loan proceeds that you originally underwrote to, right? So for us, we saw the leasing velocity that was happening, and we felt very comfortable at 95 units that, over the next 45 to 60 days, we should be able to exceed the 90%, kind of threshold we needed to go from what's called a near stay execution with Fannie Mae to a just traditional conventional loan. So that was a little bit of a risk that we took by not putting in a financing contingency. So that's part of the PSA that I think was a little bit more aggressive, where a lot of the other groups who may have been higher than us on price, they put in certain minimum occupancy thresholds in order to close the loan. Whereas for us, we said, okay, if we're not able to get to 90%, we can still take the lease up execution with Fannie Mae. It's going to be lower loan proceeds and a higher spread. But if they do really well and they continue to lease up the property at the velocity that they have been, we could end up getting another $2 million in loan proceeds, and our rate is going to come down, 50 basis points.
Mm. Well, let's switch to due diligence now. Okay, so the LOI has been executed. You said did you have 2 weeks or 30 days to complete your due diligence?
So we had 2 weeks for the access agreement where we could do on-site due diligence, and we also required that all of our requested due diligence documents were delivered within that period.
So let's talk about the physical due diligence. I mean, this is essentially, build to rent community, fairly new. Were there any issues upon the physical due diligence?
No, basically nothing. I mean, it's a brand new property. So interiors looked great. Of course, there's always going to be one or two units that need some work. But there really wasn't anything that stood out to us. We walked every single unit, walked the exterior with multiple contractors. The only thing really was there was some siding that had been punched through from the landscapers, so a couple $100 to fix here and there, but really nothing major that stood out.
Did you have the builder's warranty on this project?
No. So the way that the PSA was structured was, basically no builder's warranty. And there's some nuance in, home building where if you sell a home to a homeowner, there's a certain amount of years, depending on the state, where that warranty exists. However, in the multifamily side, they're not willing to put that same sort of warranty on it. So we were not able to negotiate that into the contract.
Well, let's talk about the financial side of the due diligence. How did that go? I mean, you're essentially fresh tenants. You don't have a T12 really to look at here. How did you navigate that?
Yeah, so I mean, we went through all of our typical checks in terms of just, confirming collections with bank statements and looking at, uh, just confirming that residents are actually paying what the AR says they're paying. Um, but it was pretty straightforward. I mean, there wasn't anything significant, and a lot of our financial kind of due diligence had to do more with making sure our forward-looking pro forma uh, could be achieved. So what that looked like was actually more than most deals that we acquire, which are not in that lease up stage. It was a lot more focused on putting in great service contracts, so landscaping, snow removal, things like that. Because this was a new property, all of that stuff was kind of on the table. So, I mean, just to give you one example, landscaping was a big line item because for these built for rent communities, every single home has a fence, right? So if the size of the door to access the fence is not wide enough, your cost for landscaping can go up significantly because they have to get off the riding mower and get onto a push mower in order to go into the backyard. So things like that were, just little details like that on the landscaping side swung the cost, $40,000 in one direction versus the other. Luckily, these were built with the larger access gates so that we were able to get the lower bid. But we spent a ton of time. We probably talked to 5 or 6 different landscaping companies locally, and just really dialed in. All right, how many cuts are we doing per year? How often are we mulching? All of those little details just to get that that contract dialed in to where it made sense for underwriting. And that was really across the board for all service contracts. So on the financial due diligence side, that was actually probably the most important thing for the success of the transaction.
Awesome. And did you have any concessions that you needed to burn off here? Was that a consideration?
They weren't actually offering any concessions, which
So a
is great.
little different than having your typical multifamily lease up.
Yeah, it was. It's in a market that doesn't hasn't had much supply at all over the last 5 years, but over 10% projected population growth over the next 5 years. So you've got a ton of people moving in and not a lot of supply. So average occupancy in the market is right around 99%. So they really didn't have to offer any concessions to get the property leased up. The biggest thing was really just loss to lease. So a lot of the leases that were initially signed versus when the lease up was completed and then what we're now leasing units at, that was the biggest gap. So like there are some leases on this property for the standard unit size signed at like $1,750, and now we're signing leases well over $2,100 plus additional fees. So you've got $400 gap on certain units. So that was, I guess, not necessarily a concession, but really just a gap in loss to lease.
Hmm. Well, let's switch to the financing side of things. You already said that in your purchase sale agreement, you didn't have a financing contingency. I'm tongue twisted today for sure, guys. So let's talk about like how did you put together the financing for this, and how long did it take you to get it pulled together?
Yeah, so that was we spent a ton of time up front before going under LOI, just working with multiple lenders to dial it in and make sure with the nuances of the lease up, we knew exactly where we were going to take this deal. And with that being said, what we landed on was going to Fannie Mae with two options. One is the lease up execution, which is what's called like a near stab execution, meaning you haven't fully stabilized the property, but they kind of stipulate as long as you exceed 90% occupancy within X amount of days after closing, we will underwrite based on the forward projections. The downside of that option is you're going to have lower loan proceeds, so they're going to restrict your LTV, and then also the spread on your loan, so your interest rate is going to be higher as compared to a conventional stabilized deal. So we went into the deal assuming that we're just going to get the near state execution, which means if we do not get the property leased up above 90% ahead of closing, we can still close the deal, but the loan proceeds are going to be lower and the interest rate's going to be higher. And then the upside is if it continues to lease up, we're going to way outperform our underwriting. and that's what ended up happening. Luckily, and that was kind of one of the biggest challenges of the transaction was just monitoring what is occupancy on a daily basis. So we were getting updates from the property manager on site almost every single day on, hey, this is how many tours we gave, this is how many applications were submitted, and this is how many leases were approved. And just monitoring that on a day-to-day basis to see, all right, where is this going to land from a loan proceeds standpoint.
And I think that's a very interesting tool for people to consider, using from a financing perspective in today's market. I'm curious. So, and to sound it back, it sounded like you went ahead and it was kind of like a stress test. You went ahead and underwrote to that near stay type of financing. And if you got it, great, you'd already underwritten to it. If you crossed the finish line and were able to, get to that 90% lease up, everybody is just having a party, essentially.
That's exactly right. Yeah. Yeah, it was pretty stressful because we went under contract, I want to say like right after Thanksgiving. So you're in the middle of holiday season, which is the worst time to lease up a property, right?
Mhm.
So they did have a pipeline of people who were scheduled to move in, but they may not have been moving in until say March or April, right? And we weren't going to get credit for that until they actually moved in and paid rent, and it was actually based on collections, right? So like how much money is actually being collected, the month of closing or the month prior to closing. So yeah, working through that holiday period, we saw the lease up really stagnate, and then at that moment we were pretty stressed because we're saying, hey, we feel like we're definitely going to get, based on leasing velocity, the better loan proceeds. Even though we underwrote to the worst loan proceeds, we started to kind of feel like we were going to get it. And then when the leasing velocity slowed down, it was a little bit concerning. And there were some stressful times in there, but at the end of the day, they ended up getting the property leased up. We did everything we possibly could. We offered to, basically pay any additional marketing expenses they needed to lease up the property that could be, basically put on the settlement statement at closing. We had all sorts of different just strategies to say, hey, how can we help with this lease up from now till closing? We were on site probably more than a buyer should be before closing, but just checking in and seeing how things are really going on the ground. So it was a pretty interactive experience between us and the seller, where we're actually on the phone with them, on a weekly basis, just checking in on the status of the property, offering our opinion. Hey, have you thought about lowering rents? That's still okay if you want to do that. So yeah, it was a very different experience than your typical acquisition, I would say.
So what did your final interest rate end up being? Is there any lockout periods, prepayment penalties, anything like that?
Yeah, so it ended up being a 10-year loan. And luckily, while we were under contract, the 10-year treasury went from like a 4.95% rate, which is like near the peak, down to, I want to say we ended around like a 4.20 note rate. And then we did end up getting a lower spread because we were able to switch. So we ended up getting like I want to say like a 5.70 note rate at the end of the day. Year one cap rate was in the high sixes, so you had positive leverage there, which was great. And because the 10-year treasury came down so much while we were under contract, we were actually able to go from a 10.9.5 loans, meaning 10-year loan term, 9.5 years of yield maintenance. We actually did buy this one down to 7 years. So we had 7 years lockout on the loan for the yield maintenance, and then 1% thereafter.
So, and I think that kind of circles us back to the business plan. What is your business plan for this particular property?
Yeah, so business plan is very straightforward. We have a pretty heavy just operating reserve and capex reserve to handle any issues that do come up. It's new construction, so sometimes you have some settling and then plumbing leaks can happen. We're going to be adding some amenities, very small stuff, grilling area. They already had a playground. Dog park's not really necessary because everybody has a fence in backyard. We've already upgraded the maintenance shop to bring in electric and plumbing. So some small things like that. But really, the core of the business plan is, one, we bought it at a really good price. It's paying well over a 6% cash on cash return in year one, which is above our pref on a brand new construction. And then you've got like $400 of loss to lease to remove between those initial leases and then to what market is today. So the business plan is really just keep the property occupied, make sure you have plenty of cash on hand in case any issues come up, and just continue to push rents. Since we've purchased the property a few months ago, we've already increased market rents $150. So the demand for this property has been really strong. We've been between 95 and 100% occupancy the entire time we've owned it, and it is one of those deals where you don't have a ton of business execution risk because you're not renovating units. It's really, we bought it at a great price. We're keeping it occupied. It's in a really great market that's got strong rent growth and tons of demand. And then we've placed great debt on it. So it is a kind of an odd deal where it's almost more like a bond than it is like a value add property, right?
Mhm. Well, let's talk about the capital raising piece of this because you did bring in investors. So how did you structure the deal amongst general partners and then also with your limited partners?
Yeah, so very standard structure. All of our deals are pretty much the same. It's either a 6% pref and a 70-30 split, or a 6% pref and an 80-20 split. So it kind of just varies on the size of the deal, what's the returns, that kind of thing, but we kind of stay within that box. So on this particular deal, we raised $8 million from limited partners, and we're paying a 6% pref, and then it's an 80-20 split thereafter. No waterfalls, nothing really fancy outside of that.
Okay. And then were there additional general partners on this deal or is it just you?
So this was a joint venture between us and one other company who we've done a handful of deals with. They're actually also local to Loudoun County here. So it's a good partnership because we both got boots on the ground. We've done multiple deals together in the past. And we're also able to just kind of bring additional balance sheet to sign them a loan, makes the capital raise go a lot quicker. So it's been a really good relationship.
So, and a good portion of the people that actually listen to the show are active operators. They're people that are trying to close their own multifamily deals. And we talk quite often that, real estate is a relationship game. It's not something to be done in isolation. You're going to go further faster if you can bring on partners. So I'm curious, how did you structure this deal with that other, capital group? How did you guys structure the joint venture and decide who gets compensated what for the deal? You can share as much as you'd like on that.
Yeah, it's very simple. We just do a straight 50-50 split. So it's we're all kind of in at the same level. They bring half of the capital, we bring the other half of the capital. We're both on asset management calls. We're both going to property site visits, meeting with the on-site team. I do think it's a little bit rare. We've had joint ventures in the past that were not that clean, where maybe you're in control and you're leading asset management, and then maybe another group is bringing the equity, something like that. I've heard of different structures like that. I would say this one is a bit unique, where it's just very just cut and dry and really easy.
Oh, well, that's fortunate for you. Before we wrap up the show, I did want to circle back to the exit plan for this build to rent community. What are you envisioning? And, what are some additional exits that build to rents have that a typical multifamily doesn't have?
Yeah, so again, just trying to keep things as simple as possible. The way we underwrote this deal is just that we'll exit this in 7 to 10 years, just as a single built for rent asset. So we'll just sell it to another buyer who's looking to buy a built for rent asset. Part of our strategy, whenever we go into these secondary, tertiary markets, we look to get to 1,000 units as quickly as possible. That way, we do have the option when we want to go sell to offer more of like a bulk portfolio sale. So we've actually acquired another 150 units in the same market since this acquisition, and we're working on a couple more right now. So part of the exit is, we do want to consolidate a number of deals into a portfolio so that we could potentially bring in a larger buyer and get a compressed cap rate at that time. Given it is a secondary market, some people are looking for more scale if they're going to go into that market. But we aren't going to do any sort of like, breakup where we try to sell off all of these units individually to retail home buyers. If we did that, the price per door right now for a retail home buyer is a lot higher than what we paid for the property. However, there's a lot of additional nuances on the legal side, on the debt side, setting up the HOA properly, selling homes, and it's not our expertise. So that's not the business plan. We see that more as like downside protection. So our thought is if, the built for rent market completely blows up for some reason, and we do have to, either continue to hold this for the long run or break it up and sell them one off because they are all individually parceled, we should be able to sell those at a decent premium. However, that's not the business plan. It's more just a downside protection.
Thank you for sharing on that. Well, I have two questions for you as we wrap up. What did you find easy on this process in this project that you thought honestly would be more challenging? And then flip that around. What did you expect to be harder that quite honestly was a little bit easier?
So, in terms of what was easier, I would say probably, it wasn't necessarily the acquisition, but the asset management of it. So my initial gut reaction was that it would be tough to continue to kind of push rents because this is one of the higher end properties in the market. So that was probably the biggest concern. And since we've taken over, we've had tons of velocity on leasing and haven't struggled with occupancy, and we've been able to push rents well beyond our underwriting. So I would say that's been easier than expected. What was harder than expected, I would say, is going back to the financing. We knew we could get it done, but when we actually got into the weeds of, going from the near state of execution to the conventional, it was, we were having to go through tenant ledgers for every single tenant to prove out, hey, you're calculating what our loan proceeds are going to be based on the collections this month, and going line by line on the rent roll and showing who's paid, what they've paid, who hasn't paid, when they will be paying, who's moving in and by what date. So I would say that was a little bit more difficult than we had anticipated.
Mm. Well, and I think that's the challenge lending has posed for everybody, no matter which side of the coin you're on in the past 12 to 24 months. So, kudos to you to getting this project closed. Kevin, thank you so much for sharing your knowledge and expertise with us here today. If listeners want to reach out and learn more about you and follow you, how can they do so?
Yeah, so probably the easiest way is you can find me on LinkedIn, Kevin Dean, or you can go to Rockbridge INV as an investor.com.
Awesome. Well, Kevin, again, thank you so much for spending your time with us here today. We look forward to hearing about your future deals.
Thank you, Whitney.